Hello, and welcome back to CFI Deeper Dive, a weekly show where CFI dives into the concepts behind the financial markets to help you stay ahead of the curve. This week, we would like to turn our attention away from central banks and into commercial banks. So far, 2023 has been dominated by global central banks and their fight against inflation. Since the last week's PCE inflation figures from the US remain stubbornly high and the labor market remains tight, it looks like the Fed, at least, still has a ways to go. To be sure, Fed funds futures are pricing in at least another 50 basis points in tightening from the current range of 4.5 to 4.75, which means even higher policy rates. And that brings us to who benefits from these rates. Historically, whenever we are in the part of the economic cycle where we have rate hikes, commercial banks stand to benefit the most. For example, Bank of America, which is one of the largest US banks, has had very strong growth in net interest income, almost to the tune of $10 billion US. Same goes for their competitor, Wells Fargo Bank, which has seen an over $9 billion increase in net interest income. And this is not limited to just US banks. HSBC, one of the largest UK banks, has also had a significant increase in 2022 net interest income of roughly $6 billion US. Even banks in Europe have benefited from rising rates, as we can see here for Banco Santander with over 5 billion euros. But why and how is this happening? For those of you who have taken our CBCA courses on banking, you will know that banks make money by borrowing cheaply and lending out those funds at a higher rate. Even with the rapid central bank policy rate hikes, most commercial banks are very slow to pass on these rate hikes to savers and pay little to no interest for deposits. For example, the same Bank of America that has recorded an increase of $10 billion US in net interest income in 2022 pays 0.01% for savings deposits. However, these banks are very quick to pass rate increases to borrowers through mortgages and loan rate hikes. Here we can see where Bank of America offers loans to their best clients at their prime rate of 7.75%. Additionally, with government bond yields much higher after the rate hikes of the current cycle, banks can easily find effectively zero-risk short-term government debt that provides them with a nice margin. For example, at the time of this analysis, even 6-month US government treasury bills were yielding above 5%. We have certainly seen a lot of banks piling into this trade, as data from Refinitiv shows European banks aggressively buying government bonds via auction, as these bond yields in the Eurozone have moved from negative yields into positive yields. Banks can also lend money to each other in the interbank markets to earn a significant spread above their deposit rates. For example, SOFR, which stands for Secured Overnight Funding Rate, is trading around 4.55%, which is the rate that a bank with excess deposits can lend to another bank on a secured basis. So this means this part of the cycle should have been good for the bank's earnings. And if we use banks' stock prices as a proxy, it certainly shows to be the case. Here we have a screen showing Refinitiv's index of developed economy banks. It shows that banks have withstood the recent down equity markets with an 8.11% year-to-date return, and has outperformed many other equity benchmarks. And if we drill a bit deeper down into the banks that have outperformed the most in the constituents, it should be no surprise that many of the top performers are those European banks that I mentioned earlier, who are taking advantage of the positive yields in European government bonds. So what can savers do if banks are not passing on higher rates? The first thing to do if you have excess cash is to look at what your bank is paying you. Many banks offer high interest savings options as well as potentially bonus rates for GICs or term deposits. If available to you, savers can deploy their cash to buy the same government treasury bills that the banks are buying. As a matter of fact, if an investor were to buy 6-month US treasury bills, they may even outperform a classic 60% equity, 40% fixed income portfolio with very little risk. Another option might be to perhaps allocate more of your cash savings into bank stocks to take advantage of higher policy and bond rates and the positive impact of this on banks' earnings. If you're interested in learning more about how banks make money and various careers in the different areas of banking, make sure to check out our free course called Introduction to Banking. Thank you for listening, and we'll see you on the next CFI Deeper Dive.